For decades, we've all heard that the American middle class is in trouble. But what if we're past the point of a slow decline? What if we're actually staring down a breaking point? Today, we're going to dig into the data and see why some economists are circling the year 2026 as a moment of, well, critical stress for the financial engine of the whole country.
Wow. That statement, it really gets to the heart of it, doesn't it? For millions of people, it's not even about getting by anymore. It's this feeling that the very foundation of a stable, middle-class life is just eroding. And it's happening even while the official headlines are shouting that the economy has never been better. So what's really going on here?
And this right here visualizes the problem perfectly. On one side, you've got the official story, markets hitting all-time highs, billionaire wealth just surging like never before. But on the other side, there's the lived reality for most people. Wages that feel like they're stuck in mud, while the cost of everything you need is just sprinting ahead. It's like we're living in two completely different economies, at the exact same time in the exact same country.
Okay, so how is that even possible, right? Well, that brings us to our first section, the Great Disconnect. We're going to unpack the mechanics behind how these two completely separate economic realities can coexist, and more importantly, why the gap between them seems to be getting wider, literally every single day. Just look at this, the sheer scale of wealth concentrated at the very top. It's just staggering. An Oxfam report found that we've crossed this historic milestone. For the very first time, there are more than 3,000 billionaires on the planet. And this isn't some small increase. It's a fundamental reshaping of wealth at the absolute peak of the pyramid. So while the top is blowing up, the middle is doing the exact opposite. I mean, data from the OECD shows this really clear 5-decade-long trend. The American middle class is getting smaller. So let's be super clear here. It's not just that one group is growing faster than the other. No, they are heading in two completely different directions. This whole phenomenon actually has a name. And honestly, it's the absolute key to understanding what's happening right now. Economists call it a K-shaped reality, and it perfectly describes this dangerous split we're all living through.
So here's the crucial point. Forget that old idea of a rising tide lifts all boats. What we're seeing now is a fundamental split. The top arm of the K shoots straight up. That's your asset owners, your top executives, the people benefiting from a booming market. But the bottom arm of the K, well, it trends downward or it just flatlines. And that represents everybody else, whose fortunes are basically disconnected from the headline numbers.
And here it is. This is that K-shape in stark visual terms. On one hand, Oxfam data shows billionaire wealth has been growing at a rate 3 times faster than in previous years. At the same time, Bureau of Labor Statistics data shows that real average hourly earnings, and that's your wages after you account for inflation, grew just 1.4%. It's not just a gap, it's a chasm.
Look, this economic divergence isn't just some abstract theory for economists to argue about. It translates into something very, very real for your wallet. It's what we're calling the affordability lie. Let's take a look at how this actually plays out in a real family's budget.
Yeah, this is the question, the one that really defines the modern middle class experience. Your paycheck gets a little bigger, but somehow your financial anxiety gets even bigger. How is that possible? Well, the answer isn't about how much you earn. It's about what it actually costs to live a basic, stable life.
Okay, let's break this down. The BLS says real weekly earnings are up 1.7%. And remember, real means after inflation, so on paper, that's a win, right? But now look at the other side. The OECD finds that the US has some of the highest childcare costs in the entire developed world. That single, non-negotiable expense for working families doesn't just eat up that 1.7% raise, it can devour an entire year's worth of raises in one go. It's like a giant anchor permanently dragging down the family budget.
So if this has been going on for a while, why are we so focused on 2026? Because on top of all these long-term pressures, two new and powerful X factors are now hitting the middle class, accelerating the squeeze and pushing the whole system toward a potential tipping point.
Okay, first up, the AI threat, and it has fundamentally changed. For years, we thought automation was mainly a risk for blue-collar jobs, but the IMF is now warning about what they call the reevaluation of technology expectations. What does that mean? It's that moment we're all having right now, realizing that advanced AI can do complex, white-collar work, things like drafting legal contracts, analyzing financial reports, even writing software. These are the very jobs that have always been the stable backbone of the middle class.
And number two, the tariff threat. Again, the IMF is pointing to shifts in global trade policy as a huge problem. But this isn't some abstract news headline, right? For an average family, this means the price of your next phone, your kids' clothes, or your groceries just slowly but surely creeps up. It's a slow-motion inflation that adds yet another layer of pressure onto budgets that are already stretched to the absolute breaking point.
Now, to be fair, is the picture just all bad news? Not entirely. There is some data out there that suggests progress. But the real question is whether these statistical wins actually feel like a win in real life. And that's where the story gets a whole lot more complicated.
So you'll sometimes hear this counter-argument, right? That the middle class is shrinking partly because people are actually moving up into higher income brackets. And on paper, that sounds fantastic. It sounds like a story of upward mobility. But does graduating to an upper middle class income really mean you feel any more secure? The thing is, for so many who have shrunk upward, that higher income is a total mirage. It's immediately swallowed whole by the non-negotiable costs of modern life. We're talking sky-high housing, student and auto debt, and of course, those astronomical childcare costs. It leaves a shockingly small slice of the pie for savings, for investing, or even just for spending on something fun. You might be winning on paper, but you're losing in your own bank account every single month.
So, after looking at all this data, the great disconnect, the affordability gap, these new threats, we're left with the most important question of all. What now? What are the real stakes if these trends aren't just a phase, but actually the new normal?
I mean, the OECD puts it in terms that are, well, they're truly stark. The risk here isn't just economic. A financially fragile middle class becomes a disillusioned one. It leads to a population that just loses faith in the very institutions that are supposed to hold society together, from the government to the economic system itself. The stakes really could not be higher. And that leaves us with this final, really unsettling question. A strong, stable middle class has always been seen as the bedrock of a healthy democracy. So what happens to that democracy when its very foundation begins to crack? When its people start to lose faith in that core promise that if you work hard, you can build a better life?
So if there's one critical takeaway from all of this, it has to be this. The old rules are changing. In this K-shaped world, just earning a bigger paycheck is no longer the guaranteed path to stability that it used to be. The real challenge now, and the new key to financial survival, is managing the astronomical, ever-growing cost of the essentials you simply can't live without. Look, at the end of the day, in this new economy, controlling your costs has become more important than just growing your income.